Okay, so first we're going to start with definitions. Ignore all this up here. I'll do another stuff. So first is the stock market. It's a network of exchanges such as New York Stock Exchange, where shares of publicly held companies are bought and sold. Okay? Stocks now within the stock market represents ownership of a company. When you buy a stock, you own a small portion or share of a company. So you buy one stock, you have one share. Those stocks are typically represented by tickers. A ticker is just a short code. So let's say you have a lease company, the ticker will be ALI. It's just a short code. And then you have indexes, which is like the S&P 500. They track the performance of a group of stocks. In this case, S&P also stands for Standard & Poor's 500, represents 500 stocks. You have the stock chart. The chart now is a graph that represents the price of a stock over a period of time. That's it. Now, a candlestick is a visual representation of stock prices for specific time period. It's for a specific time period. So if you have a chart where it says a 1 minute chart, 5 minute chart, that candlestick represents that time frame. And I'm going to show this all visually in a second. And you have an options contract. It's a financial agreement that gives you the right but not the obligation to buy or sell a stock. Now, just so you know, it could be a specific stock, but you're going to have 100 shares of that stock. So I'm going to break it down next. So here you have your New York Stock Exchange, right? This is the whole exchange itself containing the publicly held companies. And here are your publicly held companies. All your bags of candy. Now, the indexes like the S&P 500 will take these publicly traded companies and it'll say select a few of them to hold there. So now, let's say the S&P will comprise of only the red ones. That's pretty much how it breaks down. You have all of it together, housed in this stock exchange. You have all the stocks in one place. And then in the index, you'll have a portion of your stocks. Okay, so we're back at your New York Stock Exchange, right? Now let's say you have a publicly traded company called Lifesavers. Within that company, you want to buy a share, so it has a whole bunch of shares in it, right? Great. So here are all your shares, and you can buy as many as you want. You could buy 1 share, 2, 10, whatever the case may be, you could buy. Now, this is a whole share. Now, they also have something called fractional shares, which looks like pretty much this. This will be your fractional share versus a whole share. That's, apps like Acorn and stuff like that will give you a portion of one where you can invest your spare change. But that's the gist of shares. Now, when you get an options contract, you'll have one company, right? One company, but 100 of these shares under one option contract. Cool. Okay, now I want to talk about candlesticks. Pay attention. So let's say a company is bullish. Bullish means up. It's good. Here's your candlestick, right? Now, every chart has a time frame. So let's go with the 15-minute chart. So what happens is the market opens 9:30 in the morning. The price starts here and goes to here. It went straight up. This is bullish. It opens here, closes here. That's 15 minutes. Now another 15 minutes goes by, right? Now we open here because we close here. Now we're closing up here. Another 15 minutes goes by. And now you have 3 upward moving candles. Cool? Now let's say another 15 minutes go by. Boom. 4. So now the market opened. We started here. It opened. It closed. 15 minutes went by. It closed. Now the next candle, another 15 minutes goes by. It opens. It closed. That's 15, 15. That's 30. Now that closes. This one opens. Closes. That's another 15 minutes. Now it opens here and closes. That's another 15 minutes. So now we have 15, 30, 45, and an hour. So now when you're on your chart and you're looking at the 15-minute chart, you're going to see this. But if you switch to the hourly, the hour chart means one candle represents the hour. What you're pretty much seeing is now this. Now you have a long candle that opened and closed within that hour. Cool? Likewise, it's the same thing if the market goes down. It'll start here. The market opens, 9:30 in the morning. Stock's not doing too good. It'll open here, close here. 15 minutes, we're still in 15 minutes. So this is your first 15 minutes. Then another 15 minutes go by. Same thing, still going bad. Open here, you close here. Another 15 minutes goes by. Same thing. Open, close. Notice that I'm lining them up because they're at the same price. Where it closes, it has to then open in the next, time frame. So 15 minutes. Here we go again. Open, close, right? Open, close, open, close, open, close. So now this is what we did, 15 minutes. Now we have our hour. So when you switch to the hourly, you're going to get this. You open here when the market opened, didn't do so good, closed down here. Now let's say the company is not moving straight up, right? So market opens. Watch this. First 15 minutes goes up. Great. Second 15 minutes. Great. Goes up again. The next 15 minutes goes up again. Then in the last 15 minutes, it goes down. So what's happening here is that it opened here, closed, opened here, closed, opened here, closed, then opened here and came back down and closed. So now you're on the 15-minute chart. You have 15, 20, 45, and an hour. Now, when you switch to your hourly candle, what you will not be seeing is something weird like this or like this. You're not going to see that. What you're going to see is this. This looks crazy. What you're going to see is this. What it represents is that the market went up, 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 but came back down and pulled back. Okay? Actually, I'm lying to you. It's going to be like this. Because that second 15 minutes is a wash. So basically, I'm going to show you over here. Third 15 minutes, excuse me. What we had was this. Okay? What we had was 15 minutes up, another 15 minutes up, another 15 minutes up, and then the last 15 minutes down. So these two negate each other out, and that's where you get the line. So you still have your two green 15 minutes, your two bullish 15 minutes, so 30 minutes bullish, and then you had 15 minutes up, 15 minutes down. They cancel each other out, so now you get this line. This is called a pullback. So it went all the way up to as high as here, and then pulled back. Okay, so now you get that line. I'm telling you, y'all never going to forget this after all this. Y'all are never forgetting this. That is why you get that little line, and that line is called a wick. So now you can kind of see the candlestick where you have your candle down here, the wick, and you know, a candle, this is where you would light, right up top. So there you have it. Let's go to another example. Okay, pay attention. Now let's say the market opens. You're on the 10-minute chart now. All right, so this is 10, 20, 30, 40, 50, almost an hour. You're on the 10-minute chart. So the market opens here, right? The market opens here. 10 minutes later, closes here. The next candle, another 10 minutes, opens here now, closes here. Now we're moving upward. So we are now opening here, closing here, opening here, closing here, and then opening here and closing here. So you have 10 minutes down, then 10 minutes up, 10 minutes higher, 10 minutes higher, and then 10 minutes back down, right? If you go to the hourly chart, what you are going to see now, it's not these. You're going to see 2 wicks. So you're going to see the candlestick in the middle and 2 wicks. That is why it looks like that. So basically, it went down, doubled back. Now it pulled up, went up higher, and then pulled back. Okay? You can also call it a run-up. So the market opened here, went down here, opened here, went down here, ran up again, ran up again, pulled back. So now you're in the hourly, this is what you're going to see. All right, last example. I hope I didn't lose y'all. Sometimes the market looks like this, just a mess. On days like this, we kind of call it a sideways day, like it didn't do too much, but let me explain. So the market opens here, right? Now we're going to say these are 10-minute candles. We have 1, 2, 3, 4, 5, 6. So this is a full hour. It opens here, right? We go up, runs up again, open, close, right? Open, close. Then from here, opens, closes, we're down. Then we go down some more, open, close, down some more, open, close, and then it runs back up here, open, close. So we went up, came back down, came back up a little bit. In this situation, if you go to your hourly chart, this is what you'll see. You will have what looks like a cross. Just like this. Not exactly like this, it's kind of crooked, but you get it. You will have a cross. This means the market opened, right? Went up, went down, and then closed at the same place it opened. That's what that means. That means in the last hour, it didn't do anything but go up, back down, all the way down, and came back up a little bit. There you have it. That is how candlestick works. That's how they move. So when you go from any chart, from 15-minute to the hour, from the hour to the daily to weekly and monthly, this is what you'll see. You're just seeing like a compressed version of the prior time frame. So another example would be something like this. This now is basically showing the market opened here, right? This is any time frame. The market opened here, went all the way up, and then the bears, the downward pressure, pushed it all the way down. So it had a much bigger pullback and closed here. Likewise, even if I have it like this, right? This is the bears now. Bears red. This price open here, the stock opened here, went all the way down here, and the bulls, the green, they pushed it way back up and closed right there. So it's not that hard once you understand the concept. Like there's a pattern to all of it. They all flowing together. It's not like random shapes.